And a 30-year mortgage, it's expensive, especially when you pay it off over 30 years. But if you pay it off in 5 years, using the same monthly payment, is it possible? Is it true? Our next guest says it is, thanks to something called a mortgage equity accelerator. Jordan Goodman is America's money answer man and personal finance expert. And Jordan, he said, this is where we're getting ready to start. You said, have you heard about this? And I said, yeah, and I've heard about them from some people that I know and respect. Mm-hmm. But it sounds like it could be dangerous. And I'm going, I may want to argue with you about these things. Fine. What is it, first of all?
Okay. A mortgage equity accelerator is where you use a home equity line of credit to pay your mortgage off literally in 5 to 7 years instead of 30 years with basically the same payment. But it's a different kind of a cash flow. You got to keep an open mind when you hear about this.
Because whenever right there I go, wait a minute, you want me to go get another loan?
Correct.
To pay off my loan, and I start thinking of all these loan consolidation programs and all that sort of stuff.
Let's explain how it goes through step by step. Okay. The first step is you get a HELOC, a home equity line of credit, a specialized one. You're talking about a first mortgage, not a second mortgage. Okay, so you've converted your first mortgage into a home equity line of credit. That's the first step. Okay. Second thing is you put your income into the home equity line of credit. So you like direct deposit your money right into it. Okay. That's the key thing. Your income is going into it. Then you're paying your expenses out of the home equity line of credit. Typically the best thing is have all your expenses consolidated onto a credit card, and maybe you pay that at the end of the month.
All right.
Okay, you're paying expenses out of the home equity line of credit. And then, it's on your credit card bill. Then your principal is being paid down much faster because your income is in the home equity line. See, with a traditional mortgage, a traditional 30-year mortgage, you're paying very, very small amounts of principal for the first 10 to 15 years almost. True. You're making very little progress. With this, because your income is in the home equity line, you're paying principal down from day one. And that's where the power of it comes.
All right. So this is for some, but not for everyone.
Not for everybody. That's correct. So here are some things.
What's the difference?
Well, here are the things that you really want for it's appropriate for. The first thing is you have to have positive cash flow. Okay, if you got to have more money coming in than your expenses to make this work. Right. The second thing is you have to have a good credit score, typically 650 or higher. If you have below that, it's typically not going to work. But that's a lot of people.
Because of the rate that you're going to be
and be able to qualify for it.
Yeah, right.
650 or higher. And then finally, you have to have positive home equity. In other words, you have to have your home has to be worth more than the amount of mortgage you have on it. Which a lot of people is going to be true. A lot of people are not in that situation today. But if you're in that situation, this mortgage accelerator absolutely can work for you.
Now, this is a specialty loan.
Correct.
Who makes these?
There are certain banks. In fact, this started in Australia. There's a bank called Macquarie in Australia in 1997. If you go to Australia today, 80% of mortgages are in this accelerator system. They think we're crazy.
Really?
That's right. It's very, very common over there. So they brought it over there. The best place to find out about this is a website, truthinequity.com, and they find the best mortgage lender for you anywhere in the country.
Are they selling something, or are they just...
Well, they do, the mortgages. I mean, they'll get a point or so on it. But the point is, if you're paying your principal off that much faster, it's just incredible because your cash flow is going up instead of going down all the time. It's almost like creating your own bank, right? Your home equity line becomes your checking account instead of traditionally the other way around.
Give me the website once more.
Truthinequity.com.
Yep.
And you actually fill out a little form on there, and then they come back and say, in your situation, this is how it could save you tons of money.
All right. I'm very curious.
Good.
Skeptical?
That's good.
But curious.
Absolutely.
Jordan, thank you very much. Jordan Goodman. We'll be right back.